In the concluding weeks of 2025, the economy of the United States presents a multifaceted panorama of robustness interspersed with persistent difficulties. Notwithstanding a prolonged governmental cessation of operations lasting 43 days, the national economic expansion has demonstrated remarkable tenacity, propelled by substantial investments in artificial intelligence infrastructure and associated technologies. Nevertheless, this apparent vigor conceals underlying strains, including elevated inflation rates decelerating employment augmentation and a widening chasm between macroeconomic indicators and the everyday experiences of ordinary citizens. As policymakers and analysts reflect upon the year's developments, the trajectory for 2026 emerges as one of cautious optimism, tempered by uncertainties arising from trade policies, immigration reforms, and technological disruptions. The gross domestic product of the United States, a primary measure of economic output, has exhibited solid progression throughout 2025, confounding earlier predictions of stagnation or contraction. Preliminary estimates indicate an annual growth rate approaching 3%, driven predominantly by surges in expenditures on software, equipment, and data centers related to artificial intelligence. This sector alone has attracted investments exceeding $400 billion in the past year, fostering a cascade of economic activity that has bolstered manufacturing output and technological innovation. However, this growth narrative is not uniform across quarters or sectors. The initial quarter witnessed a contraction of approximately 0.6%, attributed to initial disruptions from policy shifts and global trade tensions. Subsequent quarters rebounded vigorously, with the second quarter registering an expansion of 3.8%. Forecasts from institutions such as the International Monetary Fund have been revised upward, projecting 2.0% growth for 2025 and a slight acceleration to 2.1% in 2026. This upward adjustment reflects improved prospects in industries leveraging artificial on the hub. Intelligence where productivity gains have offset sluggish employment trends. Despite these positive revisions, the economy grapples with structural impediments. The federal deficit for the fiscal year stands at $1.8 trillion, marking the second consecutive year of such elevated borrowing. Interest payments on this debt have escalated to $1.22 trillion, surpassing expenditures on national defense. This fiscal burden, coupled with an average interest rate on debt of 3.36%, raises concerns about long-term sustainability. When debt accumulation outpaces economic growth, the potential for diminished prosperity becomes evident, as resources are diverted from productive investments to servicing obligations. The labor market in 2025 has undergone significant transformations, characterized by a slowdown in job creation and rising unemployment. The unemployment rate, as reported for September, the most recent available data, stands at 4.4%, representing an increase of approximately 0.5 percentage point over the course of the year. Private payroll growth has approached stagnation, with federal government layoffs contributing to a notable decline in the fourth quarter. State-level analyses reveal regional disparities. 22 states are experiencing conditions akin to recession, particularly in goods, producing sectors such as agriculture, manufacturing, and mining. Manufacturing employment has expanded in only 7 states during the first quarter, while 11 states reported overall employment declines. These trends are exacerbated by policy interventions, including accelerated deportations of undocumented immigrants, which have reduced the labor force by an estimated 750,000 individuals since January. Industries reliant on immigrant labor, such as construction, landscaping, and crop production, have faced acute shortages, leading to project delays and elevated costs. Concurrently, the adoption of artificial intelligence technologies poses risks to white-collar employment. Analogous to the smartphone's impact on print publishing, artificial intelligence may accelerate job displacements in administrative and professional roles, although it could eventually engender new opportunities in emerging fields. Small businesses report 40% of positions unfilled, underscoring a paradox of labor scarcity amid rising joblessness. Consumer sentiment has consequently declined as households perceive economic insecurity despite aggregate growth. Looking forward, employment is anticipated to regain momentum in 2026, supported by lower interest rates stimulating housing markets and related industries. Existing home sales are expected to rebound, fostering hiring in real estate, retail of durable goods, and home remodeling. Fiscal stimuli, including tax reductions enacted in July, are projected to invigorate consumer spending on appliances and furnishings, further aiding retailers. Inflation remains a central concern, with the consumer price index registering a 3% year-over-year increase in September, the highest since January, but the slowest in 3 months. This rate exceeds the Federal Reserve's 2% target, marking the 6th consecutive year of elevated price pressures. Contributors include gasoline, food, and widespread cost increases, influenced by tariffs on imported goods. Tariffs, implemented as part of an America First agenda, have generated revenues of $601 billion, affecting 64% of dutiable imports. While intended to protect domestic industries, these measures have prompted exporters to pass costs to consumers, resulting in gradual price escalations. Shelter costs, however, show signs of moderation as housing supply increases and rents stabilize. Inflation expectations, as gauged by surveys from the New York Federal Reserve, stand at 3.4% for the short term and 3% over 5 years. Policymakers anticipate that tariff-induced pressures will dissipate in the latter half of 2026, facilitating a convergence toward the target. Nonetheless, the persistence of inflation has eroded purchasing power, particularly for lower and middle-income households, amplifying perceptions of economic hardship. The Federal Reserve has navigated a challenging landscape in 2025, issuing rate cuts totaling 0.75 of a percentage point between September and December. These reductions aim to counteract employment slowdowns and support growth, with a benchmark federal funds rate projected to decline further to a range of 2.75 to 3.00% by September 2026. The 10-year Treasury yield is forecasted to average between 4.00 and 4.25% next year. New economic projections released on December 11th reset expectations following a year marked by tariff escalations, immigration constraints, and policy uncertainties. While inflation remains unresolved, with food prices rising 2.7% annually, the outlook suggests potential for further easing if price pressures abate. The central bank's projections serve as a benchmark for incoming leadership, amid discussions of replacing the current chair in May. Trade dynamics have evolved under pay-to-play capitalism, with deals negotiated with major partners including China, India, Japan, the European Union, and others. Investments directed by presidential mandates, such as $500 billion from Japan and $600 billion from the European Union, aim to bolster domestic production but risk fostering uncertainty and cartelization. Productivity, enhanced by artificial intelligence and robotics, offers a counterbalance. Post-pandemic shifts have enabled firms to produce more with fewer resources, as evidenced by layoffs at major corporations amid rising sales. Productivity growth in the second quarter reached 2.4%, with sectors like apparel, automobiles, and electronics leading gains. This trend suggests the economy is adapting to produce more efficiently, potentially sustaining growth despite labor constraints. Global economic freedom, as measured by the Fraser Institute, has declined since 2019, influenced by pandemics, wars, and regulatory expansions. In the United States, policies such as high H-1B visa fees and deportations may hinder innovation, given immigrants outsized contributions to patents, startups, and Nobel Prizes. Despite favorable macroeconomic indicators, public perception lags. Polls indicate 59% of voters prioritize inflation and affordability, with 76% viewing the economy negatively. This sentiment contrasts with stock market highs and wealth gains for affluent households, highlighting a divide between Wall Street and Main Street. Political approval ratings reflect this tension. While strengths in security and values buoy support, economic handling draws criticism from 56% of respondents. As midterm elections approach in 2026, this disconnect could influence congressional control, with voters linking tariffs to price hikes and immigration policies to labor fragility. Initiatives like a $12 billion farmer bailout and proposed $2,000 tariff checks aim to mitigate discontent, but fiscal conservatives express unease over escalating debt. In summary, the United States economy in December 2025 embodies resilience forged through innovation and policy adaptation. Yet it contends with inflation, employment challenges, and fiscal pressures. The path to 2026 hinges on translating aggregate growth into tangible relief for households, ensuring that economic endurance benefits all strata of society. As artificial intelligence and trade negotiations shape the horizon, the nation's ability to navigate these transformations will define its prosperity.